Our overall view is that US inflation should continue to fall in line with expectations, albeit with bouts of volatility. Risks to the growth and labour market health are leading towards the downside over the medium term. The timing and number of rate cuts by the US Federal Reserve will depend on the speed at which core personal consumption expenditure, a measure of inflation closely watched by the Fed, declines. Current estimates suggest a decrease closer to the 2% level this year. This should give the Fed reason to cut the federal funds rate several times, and any risks to the downside in US growth or the labour market, as evident in certain forward-looking data points, could warrant further cuts on the Fed's part. As defensive investors, we're always mindful of downside risks. In our view, the market has priced out most downside risks to the consumer and labour market this year, with less than 50 basis points of cuts priced before January of 2025. To us, this seems excessive, given the potential for a negative surprise in economic or labour market data could lead to a rapid re-acceleration in the cutting cycle. Hence, we have a long duration bias. We are positioned defensively in high-quality corporate and government bonds with minimal exposure to high-yield and emerging market assets due to unfavourable risk-reward dynamics. There are several reasons to consider high-quality bonds. The current yields on both US Treasuries and investment-grade credit appear attractive, making it a favourable time to lock in these yields. If economic growth should falter in the US faster than expected, high-quality, longer-duration securities could provide additional total return opportunities on top of the current value in yields. High-quality, long-duration securities have proven in the past to be a good portfolio diversifier to riskier assets like equities or high-yield bonds in periods of uncertainty.